Lentus Asset Management believes that equities provide the best long-term returns and are happy to keep large cash balances in the short term if bottom-up analysis does not reveal attractively priced businesses. Nic Norman-Smith from Lentus Asset Management joins us in the studio now to discuss how they analyse stocks when determining their intrinsic value, with a particular focus on investment holding companies. Well, Nic, the word intrinsic there, like the word value, can be stretched to mean lots of things. What do you take it to mean?
We look at intrinsic value as simply as how much cash is an asset going to give us from now into the future, and that's obviously discounted back for the value of time. So cut through all the rubbish, the value of any asset is how much cash flow it throws off, whether that's a rental property that pays you a monthly rental or a mining business that that pulls iron ore or whatever out the ground.
So cash sounds like dividends, regular dividend flow?
Well, dividend flow or underlying cash flows. We don't focus purely on dividends because you may have a business that's generating significant underlying cash flows but is reinvesting that very profitably into the business and actually growing the intrinsic value by reinvesting in itself.
Chris, is that your understanding of intrinsic before we discuss what are companies that are offer intrinsic value?
No, absolutely. And look, it reminds me of what Johan Rupert said many, many years ago, that paying a dividend in many instances is seen as being an admission of failure, because by handing it to the shareholder, it's effectively saying that you can't do better by reinvesting it in the company for long-term improvement.
Well, and we talked about Pick and Pay a moment ago and the value that it delivered. Was it a good dividend payer?
Yes, it was a good dividend payer, and there was one particular reason why it was a good dividend payer, because the family, had this controlling interest.
It's the Pickwick controlling.
That's correct, and obviously they wanted to have nice dividends coming out. But in a situation where you, as I said before, when you sweat the assets of a company, and you have to start replacing those and reworking, rejigging your entire model, that's a very, very expensive exercise. And there weren't too many analysts out there that really spotted this one.
Nic, so if that's the definition, what give us the idea of your ideal intrinsic value company at its peak?
Look, any business it's all about valuation. So any business that is trading significantly below that, of course, cash flows are inherently volatile because the future is inherently volatile. So if you can invest in a business that's of a high quality, in other words, those cash flows are likely to be sustained throughout economic cycles, that they're a competitive moat or a barrier to entry against your business, then that's something you'd love to look for. So for example, a casino company in South Africa is a fantastic investment because there's a limited number of licenses, it's highly regulated, so it's very, very difficult for someone to get in. Interestingly enough, if you look overseas, they're generally very bad businesses because a lot of jurisdictions allow as many casino licenses as people want. As soon as you get that, you get big competition, as you were talking about in the retail space earlier. Big competition erodes profit margins and ultimately hurts investors. So if you can invest in a business that's of very high quality at a discount to what you believe that value is, then that's a recipe for investment growth.
It seems obvious, so why hasn't everyone done it?
Because it's very, very difficult to buy businesses at a discount. Generally, if there's a high quality business at a discount, there's some particularly bad news around at the moment. And the tough question to always answer as an investor is that a short-term phenomenon, or is this business flawed, intrinsically flawed, and is never going to be able to rebound and generate those cash flows? And that's a very, very tough question. So is it value or is it a value trap? In other words, it looks fundamentally cheap, but it's priced cheaply for a reason.
Chris, how does the platinum sector sound as we discuss these things? Long-term, used to be good cash flows in platinum, but now, of course, battling. Now, you buy it now, the valuations are very low, but when will you start getting that cash?
Yeah, I think you've got to look at it from two perspectives, David. In platinum as a metal, or platinum group metals in their own right, look, we still believe that the future for them is very, very good indeed. It's excellent. And in a world that is literally choking to death in terms of their use in autocatalysts, undoubtedly, great long-term prospects. In terms of the mining companies per se, in dreadful turmoil at this point in time. You've seen what's happened with Aquarius Platinum, shutting a couple of mines. There's a self-correcting mechanism in place here.
So the market is working.
Yes, in the sense that eventually supply will come back into equilibrium with demand, but the question remains, how long will that take? I understand what Nic is saying.
So is that the key question for you, Chris? It's not whether sometime down the road there'll be value in the share, it's the timing, because I mean, how long are you prepared to wait for that cash?
Look, you obviously would love to time it as soon as possible. The reality is, and you've answered your earlier question, why doesn't everyone just do this? Because everyone tries to time it. And timing it is impossible to do. So investing in the platinum sector at the moment, people are going, oh, let me wait for the bottom, or I don't know. If you look at the fundamental values, look at the price to book ratios of where the platinum companies are trading now versus where they have historically, look at the fundamentals for the sector. Are people going to be using platinum? Where's the price going to go? All of that points to the fact that platinum is likely to be a good investment sometime in the future. Who knows when? As a value investor, one needs to buy when you see value. Of course, the extent to of returns generated is how well you time it.
I think it was Harry Oppenheimer who said business is easy. It's just one thing. It's the timing that's difficult. So what companies are you looking at, or would you look at now from the criteria that you mentioned?
Well, there's some interesting businesses that we actually quite like. So let's chat about investment holding companies. So this adds another layer of complexity. But complexity can sometimes provide you with opportunities. So how do you value an investment holding company? Well, there's a set of underlying assets wrapped up in that holding company.
Give us an example.
So Remgro is a great example of a very, very successful business in South African history. It owns, I think, around 65% of it is listed companies, so RMB and RMH and various businesses in that stable, Rainbow Chicken, Mediclinic. It's also got a number of unlisted businesses. It's got a stake in Total, it's got a stake in Unilever SA, etc. And you need to place a value on those underlying businesses and say, how much am I paying? Now, what you've seen in the past is these investment holding companies generally trade at a discount to the net asset value of these businesses, which is understandable. There's taxation, there's trading costs, there's head office costs, various other things. So you look at it, just because it's trading at a discount doesn't mean it's necessarily attractive.